Parity. We're going to cover this learning module in 3 videos. The first video will cover introduction, put call parity and option strategies based on call parity. The second video will cover put call forward parity, and the third one will cover firm value. So in this first video, we will be talking about put call parity. In the second video, we'll talk about put call forward parity, and in the third video, we'll get to firm value. Now let's get started with put call parity. There are 4 components or instruments of this put call parity. Number 1 is an asset with the spot price S0. Number 2 is a zero coupon bond with a face value of X. Number 3 is a call option with an exercise of X, and these two X's are the same amount. And number 4 is a put option with an exercise of X, and this is also the same as the face value of that bond. Now we're going to use these 4 components to put together a relationship which we call the put call parity, which is basically a fiduciary call is equal to protective put. Now don't worry if this is feeling a little overwhelming, because of course all of this is a little bit complicated, but actually it's very simple, and we're going to break it down and understand it part wise. So first let's understand what is a protective put, then we will understand what is a fiduciary call, then we will understand why a fiduciary call is equal to a protective put, and of course where do all 4 of these components come into play. I'll just tell you a little bit about the high level situation, that a protective put is basically the asset, which is point number 1 over here, and a put option, which is point number 4. And a fiduciary call is a call option and a zero coupon bond. Now don't worry about how and why, just let's take it step by step and understand first what is a protective put, then we will talk about what is a fiduciary call, and then we will talk about why they are equal and should always be equal to each other. So what is a protective put? A protective put is buying a stock or an asset and just protecting yourself with a put option. So let's say you own 1000 shares of Apple and you bought them at $300 per share, and you think that Apple shares might go up to 400, so you're holding them, you don't want to sell them because you think they're going to go up, but at the same time you're worried that they might come down to $200. So to protect yourself, what you do is you buy a put option with an exercise price of $300, which is giving you the right to sell, at $300 per share. So in case it goes up, you don't care, you are happy. In case it comes down, you will exercise your right to sell at 300. So if you look at it in terms of a graph, this is what it looks like, that you bought at 300, and if it goes to 400, you're happy because you make a profit. But in case it comes down, you are still somewhat happy because at least you don't make a loss. You've got this protection. And how does it play out? Because I mean, obviously your shares will be going down. So if the stock price of Apple goes down to 200, so you will make a loss on your shares. But since you've got this protective put, so since you've got this put option, it will start going up in value when the share price goes down, and these two will cancel each other out, and that is why you have this net effect which is flat, right? Now just keep this diagram in mind, that this is what a protective put payoff looks like, that you've got the upside potential. If it goes up, you've got that, and if it goes down, that is protected. And now let's look at what a fiduciary call is, and you will see that this is exactly the same, and that is why the two should be equal. But first let me explain what is a fiduciary call. So a fiduciary call is a call option. Let's say we have a call option with an exercise price of 300, which gives us the right to buy Apple shares at 300, right? And we've got this zero coupon bond with the face value of X. And this X is going to be the same as the exercise price. So let me just go back 2 slides and 3 slides rather, and emphasize again on this point that the face value of the zero coupon bond is X, which is the same as the strike price of the call option, which is the same as the strike price of the put option. And this is what is given in this note over here as well, that the strike price X of the options is the same as the par value of the bond. Now let me come back to the fiduciary call here. So a call option with a strike price of 300, the right to buy Apple shares at 300, and a zero coupon bond with a face value of 300. Now face value of 300 means it will give you 300 at maturity. You might be paying less for that right now when you're buying it, because you're obviously going to be paying maybe 299 or 298 or whatever, depending on what is the interest rate and how much time duration it is for. But this 300 is the face value which you will get at maturity. Now in terms of the payoff, if Apple shares go above 300, let's say they go up to 400, and you have this call option which gives you the right to buy at 300, so you will buy at 300 and sell at 400, so you've got the upside, just like with the protective put. Since you had the shares, you had the upside, and here you have a call option, so here also the upside is yours. And the downside is protected, because if it goes down, nobody is going to force you to buy at 300. You have the right but not the obligation, so you're not going to exercise your call option, and your downside is secure. And what you will be left with is the $300, which is the zero coupon bond face value. And that is what is explained over here. That now let's look at 2 scenarios. So let's look at scenario 1, where Apple goes up to 400, and let's look at scenario 2, where Apple goes to $200, right? And what will happen in each of these scenarios to your fiduciary call, and what will happen to your protective put, and what will happen to your fiduciary call, and what will happen to your protective put. So if it goes up to 400 and this is your fiduciary call, naturally you are going to exercise your call option, buy at 300, sell at 400. So you will make a profit of X minus S, which is 400 minus 300. So you're going to make a nice profit of 100 over here. And this is going to mature, and it is going to give you 300 face value. So your total amount that you will get in this scenario is going to be $400, right? 100 from the call option profit and 300 from your face value of the bond. And in terms of your protective put, what will happen? Your put option you will not use, because that was to protect you from the downside. There is no downside here. It has gone up to 400, and this shares that you had purchased for 300, now they are worth $400. So on both sides the payoff is equal. Here also 400 and here also 400. So in scenario 1 you can see that both sides are equal. Let's look at scenario 2. If it goes to $200, naturally your call option will expire out of the money, so that will be useless. And this bond, zero coupon bond, is going to again give you the face value of 300. So in scenario 2 you will be left with $300 with the fiduciary call. Your protective put is going to help you sell this asset at an exercise or at a strike price of $300. So you have the right to sell at 300. So here also you will be able to get $300, which is equal to each other. So here 400 is equal to 400, here 300 is equal to 300. So no matter what the scenario is, whether S is more than X or S is less than X, whether you go to 400 or 200, the point is both sides are equal. And that is what this table is showing, that a fiduciary call payoff is always equal to a protective put payoff. If S is less than X, that means if you are looking at a $200 situation which is less than $300, or even if it is more, if you are looking at a $400 situation which is greater than $300, no matter what happens, the payoff for a protective put and a fiduciary call will always be the same. So in this scenario, in the $200 scenario, what will happen to the protective put? The asset of ST will be cancelled by the X minus S part, the minus S part of the put option, and what you will be left with is X, which is just $300. And in the fiduciary call, the call will expire out of the money and the zero coupon bond will mature and give you the $300, and you will be left with the $300. So here in both situations you have $300, and if it goes up to $400, naturally you will be able to sell the asset at $400, and that is what you will get in case of the protective put. The put option will expire out of the money and the asset you will be able to sell at 400. And in terms of the fiduciary call, you will make $100 profit over here on the call option, and you will get a $300 from your zero coupon bond, and the total over here will be $400 as well, which is the same as that. So this is what a put call parity is, that a fiduciary call is equal to a protective put, right? And that is again demonstrated over here, that if you have a protective put, which is the put option and the stock, right, and the spot price is greater than the exercise price, which means this is the $400 scenario. This is the $400 scenario again. So you will have the asset which you will sell at $400, and in terms of the fiduciary call, you will get $100 from this call option and $300 from this zero coupon bond, and which is also $400. So the payoff is same if you are looking at S is greater than X, and if you're looking at S less than X, which is the $200 scenario, naturally what will happen is that the stock price is less than X, so you will not wait for that. You will exercise your protective put, your put option, and sell at 300 because you have the right to sell at 300. Your call option will expire out of the money, and your zero coupon bond will be giving you $300. And in this scenario, again, 300 is equal to 300. So this is the whole point, that a put call parity is showing that fiduciary call should always be equal to protective put, and if it is not, that means there is an arbitrage opportunity and you can make free money by replicating this situation. And if, let's say for example, this is less, then you can buy this and sell this, and vice versa. So let's look at an example. There is a stock trading for Indian rupees 295 per share. An investor is considering purchasing a 6-month put option on this stock with an exercise price of INR 265. So this is X, this is S. A 6-month call option with the same exercise price is for Indian rupee 59. What should the investor pay for the put if the risk-free rate is 4%? Now, how we should structure this is, number one, we should say fiduciary call is equal to protective put. Fiduciary call is the call option, right? Call option plus the zero coupon bond is equal to the put option and plus the stock. Now the stock is trading currently for 295 Indian rupees, right? Put option is something we need to calculate, because how much should the investor expect to pay for the put? So this is something we need to calculate. Zero coupon bond, again, the exercise price they've already told us is 265, so we know that should be in the numerator, and 1 plus R, and R is 0.4%, so we will make it 1.04 to the power T, and if it is 6 months, so this should be 0.5, and the call option value they have already told us is 59 rupees. Then you can just solve for the put option. And that is what is there in the solution, that they've put the call option as 59. As you can see, they've put the zero coupon bond as x over 1.04 to the power 0.5. P is what they are solving for, and the stock price is 295, and then they've solved for the put, and they've said that the option premium for the put option should not be more than 23 Indian rupees and 85 Indian pesos. Now that you understand the put call parity relationship, we can play around with it in the sense that you can make the call option the subject of the equation, you can make the zero coupon bond the subject of the equation, you can make the stock price the subject of the equation, you can make the put option the subject of the equation, which is what we did in the previous example, right? And you can replicate any instrument by using the other three instruments. For example, we just replicated a put option with a combination of the long call, which was 59 rupees, and the risk-free zero coupon bond, and the short position in the underlying. Because why short? Because when it comes over here, it becomes negative, and hence the word short is used. We can also compare the price of an actual instrument to its synthetic version. So let's say we calculated that a put option should be worth 23 rupees and 85 pesos, and in reality in the market it is trading for 22 rupees, then we should immediately buy it and sell the other parts so that we can make a risk-free profit. So this is by exploiting the mispricing. So that is the end of this video where we were talking about put call parity. In the next video I will talk about put call forward parity, which is also a very interesting concept.